understanding the logic behind the doubling of MSME lending limits and the widening credit deposit gap is no longer optional. And finally, Shri S.C. Kalia, former ED of Union Bank of India, will analyze the sectoral impacts to maintain the depth and flow of these expert deliberations. We'll have a dedicated question and answer session once the formal presentations are over.
And then share some of the global economy has showed a remarkable resilience in 2025, but the confluence of escalating geopolitical friction, rising trade tensions is unraveling the existing world economic order. Real GDP poised to register significantly higher growth of 7.4% in 25-26. Adding good thing is the recently concluded India-EU European Union Free Trade Agreement. So excluding gold, core inflation remained stable at 2.6% in December. $88 billion in Q2 and 78.7 billion in Q3 of 24-25. And then if we do that, what will happen? Even there, providing a robust merchandise import cover of more than 11 months. So overall, we can conclude India's external sector remained resilient in response to the cumulative 125 basis point cut in the policy rate. What is the impact on the fresh rupee loan, existing rupee loan, domestic term deposit, existing fresh, etc.? That is being captured in the slide. By a quick recollection, SCB's credit has grown up by 14.54% in December, and in December 25 over December 24, deposit by 12.68%, CRAR at a healthy level of 17.24% in September 25. Indian economy continued to register high growth despite challenging external environment.
Thank you very much, Sunarajanji, for laying the domestic macroeconomic conditions and the outlook. The MPC voted unanimously to keep the policy rate unchanged at 5.25% under the liquidity adjustment facility. Consequently, so going forward, the MPC will be guided by the evolving macroeconomic conditions and the outlook based upon the data from the new series in charting the future course of the monetary policy. Then there were some developmental and regulatory policies were announced by including a framework for compensation in case of small value fraudulent transactions, that is up to a compensation up to 25,000 for loss incurred in a small value fraudulent transactions shall be issued shortly, taking into consideration the growth in total loans and advances of UCBs over the past few years. In this regard, also the draft guidelines will be issued directions shortly. Payment system, second area. Revision in the guidelines of Kisan Credit Card. It is now proposed to issue a revised set of instructions to banks on the scheme, consolidating those on agriculture and allied activities, out of which already 80%, so that limit has been now waived and it is being allowed under the general rule. The mission will be pursued with the partnership with the umbrella organizations of UCBs and national and state federations. So friends, these are the various announcements made in the monetary policy announced on the 6th of this month. Thank you very much.
So significantly, the policy rate were kept unchanged as was shared by Dr. Farid. That is going to take place because of prices of gold, as he was mentioning, and maybe also because of some kind of pickup in the prices of crude. Let me first of all talk for outstanding rupee loans. It is only 81 basis points. Now comes the question of credit growth outlooks. How is it going to impact the credit growth? And I personally believe that this particular announcement that is being made, where the banks are being given an opportunity to now lend to REITs also, this opens yet another avenue for banks to deploy credit. That is about REITs and increase in collateral-free loans to MSME sector from 10 lakhs to 20 lakhs. I think RBI conducted OMO of 3,50,000 crores. A positive thing. There is absolutely no issue. If we look at the kind of interventions RBI made in the December and January month, when 3,50,000 crores were was injected by way of OMO, even if we look at comparative, I think, analysis, it is continuously GNPA levels and NPA levels are improving. So these figures that have been given and the fact that now there is a stability of lending rates by Reserve Bank of India in its report, they say that all other parameters so far as banking system is concerned, it is very, very sound and robust. CRAR is 17.24% as on September 25, resilient. So far as NBFCs are concerned, there are some two significant announcements that have been made. And then in respect of investment and credit companies, which are in the business of lending gold, there was earlier restriction that they have to seek authorization for opening up branches beyond. I think excepting in one or two areas. Now let me come quickly for enhancing the collateral-free loans from 10 lakhs to 12 lakhs. This is going to be very beneficial for this particular sector. Service exports in the month of December YOY of rice and wheat and the kharif production is expected to be higher even on a YOY basis by 2.3%. Rabi sowing is doing very fine. So basis that, and I think this kind of scenario they are doing, be it steel, be it cement, all these sectors are doing reasonably well. And the impact of all these, announcements, which have been and data that have been shared with us.
For that beautiful presentation on the impact that is going to be there on banks webinar that we are going to have on the next Sunday, and give your feedback. It is very important for us and it helps us to improve the quality of our webinars in future.
Our senior mentors are how meticulous about what has been told in the policy and what would be its impact on the economy. They are very serious about it. Means RBI is a target group, stakeholders are many. This may be a very good policy because they are not going to immediately reduce this EBLR based lending rate, and deposit rate will be revised only when it comes to maturity. The pressure will not be too much on the net interest margin. In December, bankers were not that very comfortable, mainly because rupee was under pressure. When you are having buy-sell swap also, you are injecting liquidity immediately because you are buying foreign exchange, and sell is anyway contingent liability. That was mainly because of valuation and valuation of mostly gold. The net balance in the market was not very high since mid-December. Increase in the credit growth surpassed the deposit growth. This compensation is not a solution. We have to reduce this, fraudulent activity because we cannot avoid going ahead with digital transaction. We cannot avoid going ahead with AI adoption because we are the fastest growing economy. Our growth momentum is maintained. Capex heavy. So this potential growth is not sufficient to become a developed country by 2047. And your problems are more or less resolved for the time being. Why the corporates are waiting for so long for increasing the fresh investment? So how can you reduce your interest liability? Do you think the investors are so full? Other countries are following. Thank you very much. 30%.
I am saying this, do you agree or not that this intervention which Reserve Bank of India is having?
First, 7.1% increase at a slightly higher rate than the nominal GDP growth so that it will safeguard your future.
Look at the trajectory.
Quality control, all these reform, the structural reform, so that private invest. So government is doing its best, not that the purpose. See, this is impossible trinity. If you want to maintain independent monetary policy, allow the exchange rate to be as flexible as possible because of this uncertainty, because of the trade-related restriction imposed on our exporters. So the RBI tried to reduce their presence gradually from October to November, November to December. Now probably there is no need. Now coming to inflation projection. I will tell you, February and March inflation is awaited. Next inflation should be more than 3.4 for consecutively 2 months. Then only it will be 3.2.
Thank you, Kalia sir and Bhoi sir, for that very engrossing discussion and framework. So please use the raise hand feature or post your queries in the chat box, and we'll take them one by one over to all the participants. In the meantime, sir, Sundarajan sir, there is a, please unmute yourself, sir.
Thank you, sir.
Right.
Okay.
Yeah.
But money was not available even for credit growth.
There is a question from the participant. CD ratio is 81.75% or 82% of the system. Retail deposit momentum is only 35% of net savings. Lending growth of 2%.
Central government borrowings and state development loans that have been projected, 22.1% is the growth that is expected. Effect any kind of reduction in the SLR requirement of the bank.
I agree with you, sir. I agree with you. In fact, about 2 years back, this issue received the attention of the regulator.
They were forced that 50% of their incremental lending, they will have to resort beyond 10,000 crores. That requirement which was there just to restrict, that has been dispensed with. So I'm not in a position to reconcile. How can they come out with and they say, okay, now we are going to do this?
Debt is a stock at any point of time. What government is interested, that debt GDP ratio. So debt GDP ratio, you are not in a position to reduce as per expectation of the guidelines provided by the FRBM review committee. You bring it down to 50% plus minus 1 by 3031. Please specify. All share prices are not rising. Share prices of certain sector is rising. Real sector reform hua kahan?
When rural demand is picking up, urban demand is picking up. That's why. Earlier it was all led by government expenditure. Now it will be also supplementary by private sector capex that will take place with these kind of developments that we are seeing in the economy.
Oh, I studied somewhere, empirical study. Sure.
I would like to extend a heartfelt thanks to our distinguished speakers. I will be uploading it on the website. And for those who are joining us as one-time attendee today, I request them to consider taking up formal membership of the Elite Bankers Club.